Good afternoon and welcome to the ADEPT Technology Group PLC Trading Update Q&A session. Throughout this recorded session, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. So Phil and John, thank you very much for your time today. Before we move on to the main Q&A session, Phil, I thought it might be a good idea if you just give us a brief overview of the business.
Yes, happy to. So thank you very much for joining this session today. We feel this is a good platform to have a conversation with investors, and I hope you appreciate the gesture. So the best way to envisage ADEPT is really to look around any business today, or school for that matter. We do a lot of work in education. For organizations to be successful today, they need to be resilient, they need to be secure, they need to be agile, they need to be an excellent communicator both inside a company and also externally, and be a fantastic employer. So they're the sort of elements that we believe are essential to be a great organization. So information technology has a role to play in all of these, whether that's a cloud-hosted telephony solution or access to information over a high-speed network, or a suite of applications that process data. If you add in all of that, or add into all of that physical equipment, the Wi-Fi facilities that are required nowadays, accounting platforms, all wrapped in a professional services that helps clients navigate this sometimes quite complex world. If you visualize all of that, you can now picture the range of services that we provide to a whole range of customers across the UK. That's who ADEPT are.
Thanks, Phil. And we noticed that you issued a trading and strategy update on the 7th of April. And if you could run through the key points for us as well, that would be great.
Yeah, it's sadly trading updates are relatively detail light. We publish our detailed information later on in the year once we've concluded the audit of the business. But we're sharing a resilient performance in FY22. If you can recall, we set the plan out back in March last year. So quite a lot's happened from a macro situation over the last 12 months. But if you look at our performance for this last financial year, we're declaring a resilient performance. We've secured some major contracts and over 100 new customers. So we've been successful out in the marketplace, and we're sharing a results sort of broadly in line with trading at a revenue and adjusted EBITDA level. Yet our debt figure is slightly ahead of what we're expecting, above forecast.
Thank you very much for that, Phil. So now might be a good time to turn to the pre-submitted questions which investors submitted. And the first one reads as follows. You talk about organisational changes in the trading update. What are these and how they benefit the business?
Yeah, very good question. So we have been on a crusade over the last 3 years to simplify and rationalise the business, and also establish very consistent operational platforms. And we've broadly concluded that there'll always be some things to do, but broadly we've completed what we've called Project Fusion, which was to integrate all of the different component parts of our business, so that all employees can use the same solutions irrespective of where they work. So we've undergone that integration of systems, and that allows us to also integrate management teams. I inherited a business 3 years ago where there were a collection of management teams running their respective small parts of the operation, and we've been gradually rationalising those business entities, and we're announcing at this point now that we're down to 2 discrete operations. The ADEPT South and Healthcare team and the ADEPT North and Education team. So that enables us to take some cost out, but more importantly, improve the services to customers, because we want to take our whole solution set to every single customer we deal with. And by rationalising the business entities, it removes walls between departments and rationalises the business, but also improves the service we give to our customers and the range of offerings we can talk to them about. So that's been the real objective in terms of simplifying the organisation.
Perfect. Thank you very much. The next question is really about Datrix and asks if you're pleased with Datrix's performance to date. Was it worth the money and the extra debt taken on by the company to acquire it?
So I'll let John talk about the financials in terms of the consideration and the earnout. But broadly, when we acquired Datrix, again, it was last April, so 12 months ago. We announced that as a game-changing acquisition for us because it took us into a fast-growing marketplace and evolution of where we were operating. It took us into some larger customers with a bias towards the public sector. And it brought on board a skilled team of individuals that knew about that space, as well as a financially growing organisation. So they were the key characteristics of the Datrix acquisition, and we're very, very pleased with the performance of that business. It was a very logical and sensible acquisition. They're now fully integrated into the business, so they're operating as part of the ADEPT South and healthcare team. They've won some very substantial contracts across both public and private sector. They've grown both at a revenue and margin level. So absolutely delighted with the performance of that business. It was a very good decision, and it's worked out very well for us. Well, John, do you just want to talk about the initial consideration and the earnout piece to that? I think I've just had a bit of colour for investors.
Yeah, so we paid the initial consideration in April of the last financial year, and it was a 12-month earnout which ended on the 31st of March. Now, we don't have the final results yet, and we're going through a process of drafting those and going through the audit process. But we are expecting to pay an earnout on that business because they have hit some of the growth targets that we set. It won't be at the max end of the earnout, but it will be a good number, somewhere between probably around 4 to 4.8 million earnout, because we've seen significant growth in the recurring margin part of the business, which is the bit we incentivise people to do, because that's where it's going to deliver long-term value to the group.
Perfect. Thank you very much. The next questions asks around your plans for the coming year and how will you exploit the market opportunity better?
Yeah, so the plans for the coming year, we talk about 3 pillars, but it's organising for success. We've sort of talked about that in terms of rationalising and simplifying the structure of the organisation. The other 2 pillars relate to organic growth and pay down of debt. So let me talk about organic growth, and then I'll pass over to John to talk about the debt piece. We, as a result of our consolidation activities and our general consolidation skills across the group, we believe we've got a range of services that we can now take very successfully to market, and don't believe we have that many other capabilities that we need to provide a full service to our customers. And the strategic review that we undertook during the course of the last 12 months really reinforced that. We have the opportunity to step into relatively fast growth marketplaces, whether that's in cloud, whether that's in security, whether that's in software-defined networking. So we have expertise and capability in those spaces, so we can step into those fast-growing markets and capture our deserved market share. So as a result of that, a real focus on organic growth and training, educating our sales team to carry that message, and then winning those opportunities is very much our focus for the coming period. And then obviously paying down debt is an important part of our mission that we've declared as part of this trading update. And I'll let John sort of talk about the mechanics around that and our mission there.
Yeah, I mean, with a strong cash flow model, with modest capex of 1 to 2% of revenue, 80% of EBITDA is turning into free cash flow. So able to pay off our debt at quite an encouraging rate as we look forward. Obviously, in the next financial year, it will be reduced slightly because we will have that earnout to pay on the Datrix acquisition. But we can see a substantial reduction in leverage over the next 24 months. Even post the acquisition of Datrix in the current financial year, we've been able to repay 4.4 million of our loan facility, which is testament to the strong cash flow generation of the business model. And yeah, we look to continue with that, reducing down the leverage to below 2 times in a relatively short space of time. It is a very realistic target for the business.
Perfect. Thank you very much for that. How do you see the market evolving over the coming months and years, and will you need to acquire other skills to exploit new market drivers?
Yes, how's the market evolving? I think it's there's been a huge amount of acceleration to cloud over the last couple of years, and I do not see that abating whatsoever. The pandemic has really brought cloud to the fore. So as a result of that, we will, we're very much engaging with customers with the cloud first strategy. Our first conversation is, how do you want to rationalize technology? How do you want to move to the cloud? How can we help you do that? Whether that's hybrid or public cloud as a potential destination. And we've helped a number of organizations on that journey. So I don't think that's going to abate. We're still going to be having those conversations. And then the second piece of that is security. We've seen some of our customers sadly suffer threats from external bad actors, and we've been fortunate in terms of having tooling in place to protect them from that threat. So I cannot see that security piece abating either. I think those two things do very much go hand in glove. So I can see that continuing. I think the third piece probably worth sharing with investors is we're increasingly seeing organizations wanting to take consulting services to help them on that journey, but also to add some integration, some unifying services that bring all of those different component parts together and graft on those additional the additional glue or adaptation of the core platforms. And we're starting to see that in some of the larger engagements we're moving into, and that I can see that being even more of a play in terms of our business going forward, and hence our big push for consulting services. We've already got some expertise in the business. We've got experience in running the largest Office 365 estate in Europe. We've got great experience in deploying the largest Cisco firewall estate in Europe. So we've got real experience in this space, and I can see us doing more and more of that integration and provision of the glue that pulls together these component solutions going forward.
Thank you very much, Phil. Just looking at the strategic review, an investor asked, what was this for and what did it tell you?
Yeah, very good question. We call that out as an exceptional spend item in the last 12 months. We spent a lot of time with a consulting leader, Ernst & Young, to help us answer a host of questions, including what demand did they foresee in the market? Where are those fast growth parts of the market that we need to tap into? How are ADEPT positioned to address that demand? How do we compare to our peers, which is always a crucial question in terms of competitiveness? What do our customers think of us through us? And we did that through a survey. And what proportion of wallet share are we able to capture? Which again is a pretty crucial question, because if you're looking to evolve organically, you've got to be able to prove and demonstrate you can capture a substantial amount of the wallet share. You haven't got any big holes in your portfolio. And I think the frankly reassuring feedback is that we have the range of services. We can capture a substantial share of wallet. We have the appropriate expertise. We have a fantastic reputation with our customers. So bringing all of that together, it does reinforce the strategy of building organically as opposed to through acquisition. It was that the study effectively said, you have all the component parts, just focus on execution, and as a result of that, organic growth will flow. And I think that's very much the story of this trading update.
That's great. Could you explain why the management team did not have the bandwidth to come to the conclusions made by EY Parthenon?
Oh, very good question. I think we do, but I think the difficult thing is you do bring into those sort of activities your own prejudice. So my background is software, for example. I'd spent 20 years in the software business before moving into this business. So I will bring baggage which attaches to software. We've got people who are data and network specialists, so they'll bring that baggage to the table. We've got people who are experts in software-defined wireless area networking, so they'll be championing that cause. So if you're not careful, what you do is you bring all of that baggage to the table and you end up drawing the wrong conclusions. And when you're setting a strategy for a business employing 340 people, with a market opportunity that has been declared as 11 billion in size, with a range of different places to be able to hunt in terms of fast-growing market opportunities. I think our team, our management team, and our investors deserve a third-party, very very intense activity to answer those questions from an independent perspective, not one that comes with some potentially prejudicial baggage. And I think that's the principal reason. So not really a bandwidth question. It was more that we wanted the conclusions to be of very high quality based on market data rather than a supposition and pre-baked ideas.
Thanks very much. The next question reads as follows. How do you see inflation affecting company profits? Are you tied into long contracts with customers, or can you renegotiate prices mid-term to reflect the cost of inflation?
John, are you happy to answer that question?
Yeah, sure. So inflation will certainly have an impact on salary expectations, not just in our market, but also in other markets across the UK. We're doing our best to manage that through the use of promotion of people internally, trying to move them up the chain, and also using apprentices, bringing them in to upskill them to provide that opportunity to work their way up through the ranks of the ADEPT group. And then also alongside that, we've just introduced a new flexible benefits platform for staff, which will be rolling out over the next 6 months or so, which will provide staff with sort of some intangible benefits and some the benefit of increased buying power. So we're going to do our best to manage that salary inflation, and we'll just have to see what comes over the next few months. Inflation on wholesale pricing, we'll largely pass that through as it will apply to the market as a whole. And we've got some very strong partner relationships which we've developed over the last few years. They give us competitive pricing and marketing support, so we'll use those to try and continue to manage our margins and keep them flat or maybe even increasing. With regard to long-term contracts, yes, we do have some long-term contracts with customers, typically where they're involved with some element of third-party wholesale supply. Then we'll back-to-back those with suppliers to make sure we're not exposed. So we'd only enter a fixed price contract with a customer where we've got certainty on the wholesale pricing in things like, for example, data connectivity. Variable elements of customer contracts won't be on a fixed price basis. And although no customer is ever pleased to receive any notification of a price increase, inevitably there will be some over the next period. And we do have the right to pass through wholesale cost increases at any point during contract terms, and also the T's and C's that we have allow for RPI increases on an annual basis. So yeah, we're going to do all we can to try and manage inflation and retain margin.
Thank you for providing a bit more clarity around that, John. And that actually does conclude the pre-submitted questions. But as you can see, we've received a number of questions throughout today's presentation. And thank you to all the investors for submitting those. Could I just ask you to read out those questions and give responses where it's appropriate to do so? And then I'll pick up from you both at the end.
Okay. So there's a few of these hopefully we've answered as a result of the Q&A we've already done. But happy to sort of run through some of these. So the first one I've got here is, what is your dividend reinstatement plan and what is your target dividend cover rate? Well, you'll notice that in the trading update, we stayed silent on dividend for a very good reason. We suspended the dividend because of substantial macro uncertainty in the economic environment, which was driven by COVID. And we would argue that we're not quite out of the woods yet. There's inflation, there's supply chain challenges. You've got the conflict between Ukraine and Russia. There's a whole raft of quite substantial macroeconomic circumstances which haven't washed through yet, and we're not out of the woods in terms of COVID. If you look at the lockdowns that are still happening in China, so because of that uncertainty, we found it unreasonable to start declaring a dividend reinstatement at this stage. But it's certainly something that the board will continue to examine in the coming months. And as soon as we feel confident that that is warranted, we'll let investors know. Okay, next question. What relevant areas of the market do you still see as underrepresented within the internal ADEPT skill set, and will you target in future acquisitions? Again, very good question. I think the strategic study and our own view of the skills within the business is that we have 340 skilled people. We have a great range of expertise. We have the ability to recruit in different locations. So we have the ability to extend and build out our team, whether that's in Doncaster, Orpington, Northampton, or Dorking. So that gives us the ability to go recruit, to extend the business rather than go acquire. And I think the reassuring information from the strategic study is that we have the skills and portfolio to capture some 60 or 70% of the wallet share within our target customer, and therefore there isn't a massive gap in terms of our portfolio. So it's more build rather than buy. We'll focus on the likes of security, cloud, Microsoft as obvious targets for recruitment, and that's where our attention is now turning to. And there are areas where we already have skills worth pointing out. The next one, I think we've covered. What are the trends in pricing and our existing contracts being renewed at much discount? John, do you want to answer that one?
Yeah. So yeah, we do see pricing pressure on the top line. As customer contracts come to an end, typically within the data connectivity world, then there is a trend of decreasing pricing. However, we try and manage that through upgrading customer services. So trying to retain that same level of pricing, but providing them with a better service or more bandwidth, etc. Because typically the wholesale pricing is also going down of those services. So the margin retention is all about upgrading, giving the customer more for the same price and tying that back in. So we margin retention, but at the same time, we are trying to put through price increases onto customers to maintain margins, and it's all about solution selling for us. We're trying to move up the food chain, trying to sell into big organisations a solution rather than single point products where there's a bit more pricing visibility. We're trying to wrap it all together into a solution for that customer to make it less able to be visible of the component parts of that, which helps avoid some of that pricing pressure.
Okay, the next question I'll pick off the list is, and I think it's a very good question, I'm glad to answer it. A broadly aligned trading update implies that in some respects the company's performance is below expectations. So in what areas has the company underperformed and how will this be rectified? I think that's a really good question. I'll start answering this, John, and if there's anything that you can add, then by all means chip in. I think it's been a frustrating year. The last 12 months, we set our plan back in March last year, and to be honest, when we set the plan out, we thought that the pandemic was on the wane, so we didn't foresee it continuing for a further year, and that has certainly hampered a little bit of our progress. And obviously, the horrific impact, events in the Ukraine has had a further impact both in supply chain as well as customer ambition. But nonetheless, we've had an excellent sales quarter coming into this conversation. So I think the biggest frustration, though, is the ongoing challenges relating to the IT supply chain, and they've impacted us in two ways. I mean, firstly, we can't ship the equipment that we've sold, so that adds a delay in terms of securing the revenue attached to the orders. But also, probably of more significance, particularly at the gross margin level, is that we're unable to deliver the services alongside the provision of equipment. So you've got a double whammy there, which is really causing us a lot of frustration. So we've got an increasing backlog of orders and deferment of revenue into future periods that sadly we do impact. We do look at alternative equipment providers. We do look at pre-purchasing stock, etc., etc. So a lot of things that we can do to mitigate that exposure to deferred revenue. but it is something that causes frustration. And the Ukraine-Russia situation is actually affecting chip manufacture and chip supply, which then feeds through into the equipment that we buy on behalf of customers. So you've got a whole collection of quite substantial macro economic factors. So that sort of explains the big variance. We've also pre-purchased some equipment that we can't ship until early next year. So you've got that impact in terms of the debt piece. But I mean, broadly, when you think that the plan was set back in March, April last year to be trading broadly in line, I'm actually pretty proud of the achievement, albeit not quite where I was hoping to be at the end of the financial year. Anything I've missed there, John? I think I've covered most bases with that answer.
No, I think hitting 95% of the plan, roughly from what we forecast a year ago, when we actually thought that the economic environment was going to start improving more quickly than it has. I think that the business has been faring well. How long it will take for those IT supply chain pieces to unwind is a question which I'd love to know the answer to that, but I can't see it disappearing certainly over the next 6 to 12 months. So it would inevitably have some impact on next year, but we've got the carryover of those delayed revenue recognition items from this year. So hopefully that stopgap will be partially reversed in the forthcoming 12 months.
Thanks, John. And then the next question, will your revised strategy result in a change in the customers you target for new business? Again, very good question. We have a very strong presence in education. We have an increasingly strong presence in healthcare, and you can see that with the naming conventions that we'll be focusing our attentions in those two areas alongside others. In terms of customer size, we're increasingly winning larger projects. So there's a good profile of larger engagements that we've been successful in winning, and obviously that's something that I would like to see more of. So we've got some focus in the sales organisation around those market sectors and also size of customer. Again, I can't help but emphasise we have an £11 billion target opportunity within this marketplace. So there's plenty to run at as long as we execute well and we displace some of our competitors on that journey, which goes neatly to the final question, I think, from this investor list, which is the key drivers behind the success in winning new customers. And I think the key drivers, there is a mission to simplify the IT landscape, and if we are able to provide a full range of services to solve problems our customers present to us, I think that makes a big difference, and I think that makes for a lot of opportunity out in the marketplace. But I think probably the most important driver is customer satisfaction and referrals. We really do focus on operational excellence, customer satisfaction, intimate customer engagement. We've got people who are service managers, and their brief is to make sure our customers get a fantastic result in their engagement with ADEPT. And I think if we continue to focus on service excellence, I think everything else springs from that, and that service excellence is achieved by continuing to motivate and inspire our staff, which is why it's part of our mission. Okay, I think I've covered all the questions that have been submitted.
Thank you for that, Phil. I think you actually addressed all those questions you can from investors. And of course, the company will review all questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, Phil, could I just ask you for a few closing comments?
Yeah, I'm very much hoping we're getting across that we have had a good year. There have been some challenges. We talked about supply chain and whatever. So there have been some challenges, but I think we've responded very well to that. I think we're seeing the benefit of our strategy to unify and rationalise the business, and you're seeing that with the cost takeout and the enhancement to the organisation that we've managed to execute over recent months. I think the company's in a good position. We're in a marketplace where certain pieces of that marketplace grow at double-digit rates. If you look at the analyst reports, software-defined wireless area networking, security, cloud, there's some very substantial growth rates attached to those markets. So as long as we swim in those parts of the river, I think we'll have a good year, and that's very much our focus. So very much thank investors for their support, and those individuals who are considering investing. I hope you've found this last 30 minutes or so useful.
Phil, John, thank you for updating investors today and answering all of those questions. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of ADEPT Technology Group PLC, we'd like to thank you for attending today's Q&A session, and good afternoon to you all.
Thank you.